Tax season is upon us once again, and if you recently started a new business or incorporated your existing business, filing your taxes will look a little different this year. I'm John with Ontario Business Central, and today we are going to walk you through our guide to small business taxes in Ontario. In this video, I will cover some of the most essential information about filing taxes for small businesses in Ontario, so you can have a better idea of what to expect on your tax return. Let's get into it. First off, many people wonder about the typical tax obligations for small businesses, such as sole proprietorships or general partnerships. A common question is, how much do they usually pay? For registered businesses that are not incorporated, like sole proprietorships or general partnerships, you are taxed at personal tax rates for income earned through your business. For general partnerships, each partner simply calculates their share of their business income and reports it on their personal tax return. Click on the CRA link in the description below to see the current federal and provincial personal income tax brackets across Canada. Now, let's break down how much you will have to pay for taxes for your incorporated business. The Canadian and provincial governments offer a lot of tax incentives for small businesses. The idea is that by charging small businesses lower tax rates, more money can stay in the business to help it grow when it needs it the most. However, most of these tax benefits are only available to incorporated businesses. This is one of the biggest advantages of incorporating, along with many others like reduced personal liability and improved brand protection. If you've been thinking about incorporating, check out our other videos on incorporation to help you decide if it's the right move for your business. One major benefit of filing taxes for a business, whether you incorporate or not, is that you can take advantage of the tax write-offs for expenses incurred in business operations. There are a lot of expenses that you can use as tax write-offs, such as capital property like business vehicles, equipment or tools, product costs for things like packaging, inventory, or even research and design. Home office expenses if you work from home and have a dedicated office space, marketing expenses, online tools and services, and many other miscellaneous expenses like travel costs or office supplies. There is quite a bit more detail about how to write off these expenses while remaining compliant with CRA requirements and restrictions. But that goes beyond the scope of this video. Leave a comment below if you would like us to expand on this in the future. Tax rates for small business corporations look a little bit different. Most small businesses in Canada receive a much lower corporate tax rate if they qualify as a Canadian-controlled private corporation, CCPC. This basically means that your company is incorporated in Canada, owned by Canadian residents, and is not publicly traded. The federal CCPC tax rate is 9%, and the provincial tax rate in Ontario is 3.2%, up to $500,000 in profits. So, the total corporate small businesses tax rate in Ontario is 12.2%. Not bad compared to the personal tax rate for registered businesses or the corporate tax rate of 26.5%, which applies to non-small businesses, meaning you have over 500 employees, or for small businesses with an income of over $500,000. This tax rate applies only to active business income, which is essentially any income earned through normal business operations. Income earned from investments is subject to a different tax rate. The federal rate for investment income is 38.7% and the provincial rate is 11.5%. Investment income can come from a variety of sources, but often includes interest income, dividend income, royalty income, income from rents, taxable capital gains. Corporations can reduce this tax rate by paying out dividends to their shareholders to earn a dividend refund. As a small business owner, you have a few options when paying yourself through your corporation. One option, as mentioned, is to pay out dividends, which have the benefit of gaining tax refunds for your corporation and being taxed at a lower rate on personal tax returns thanks to dividend tax credits. However, dividend income doesn't count as earned income for RRSP contributions. The other option is to pay yourself a salary, which will then be taxed at the normal personal income tax rate. The best option for paying yourself will ultimately come down to your personal goals and tax situation. Often, accounting professionals will recommend a combination between these two options to provide the maximum individual benefit and the lowest tax rate possible. It is important to discuss your specifics with a tax specialist or CPA to gain the maximum tax scenario. Let's wrap this video up with a brief chat about filing HST. Businesses that earn over $30,000 per year are required to collect HST from their customers for all goods and services provided. To collect HST, you must register for an HST account through the Canada Revenue Agency and report it either monthly, quarterly, or annually, depending on the reporting schedule assigned to you when you register. When you file an HST return, you can get back the HST that you paid on business-related purchases in the form of input tax credits. On your report, simply indicate the amount of HST collected as well as the input tax credits, then pay the difference. I hope this video has helped you gain a better understanding of how small business taxes work in Ontario. Remember, Ontario Business Central is here to help you succeed as a small business owner. We can handle the process of registering or incorporating your business, registering for tax accounts, and so much more. Check out our website for more information, and as always, if you enjoyed this video, don't forget to like, comment, and subscribe. Thanks for tuning in. We'll see you next time.